Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of why the P/B ratio matters in value investing. The price-to-book P/B ratio might sound like just another financial term, but it's a crucial tool for investors looking to make smarter decisions. Why is this ratio so important? Simply put, it helps investors determine if a stock is undervalued or overvalued by comparing the market value of a company to its book value. This quick yet insightful check gives a peek into whether you're paying a reasonable price for the company's assets. In this video, you'll get to know how the P/B ratio works, why it matters, and how to use it effectively in your investment strategy. Ready to cut through the noise and make informed choices? Let's dive in. Understanding the P/B ratio. Navigating the financial markets can feel like sailing through uncharted territory. The P/B ratio is one of those trusty compasses that helps investors find their way. But what exactly is this tool, and how can you use it to make better choices? Let's break it down. Definition of the P/B ratio. The P/B ratio, or price-to-book ratio, is a financial metric. It compares a company's current market price to its book value. Think of book value as a company's net worth if you sell all its assets. This ratio tells you how much you're paying for $1 of a company's assets. It offers a glimpse into whether investors overvalue or undervalue a company. The formula explained. To calculate the P/B ratio, use this simple formula. Text P/B ratio equals frac text market price per share text book value per share. Market price per share, the current trading price of the company's stock. Book value per share, calculated by dividing the company's total assets minus liabilities by the number of outstanding shares. Why it matters. So why should you care about the P/B ratio? It's like a magnifying glass that lets you inspect the true value. A lower P/B ratio might suggest a stock is undervalued, providing a buying opportunity. On the flip side, a high P/B ratio could mean the stock is overpriced. This is where the magic happens, sifting through numbers to spot hidden gems or potential pitfalls. But remember, it's just one tool among many in an investor's toolkit. It works best when combined with other metrics for a well-rounded view. Practical use. Want to put the P/B ratio to work? Start by identifying companies with a P/B ratio lower than the industry average. These might offer potential value. But don't stop there, dig deeper to understand why the ratio is low. Is it justified, or has the market missed something? So, next time you're weighing investment options, pull out the P/B ratio. Consider it a friendly nudge, guiding you toward smarter decisions without getting lost in the fog of financial jargon. Importance of the P/B ratio in investment analysis. When you're trying to get a handle on a company's worth, the P/B ratio is like a secret decoder ring. It strips away the fancy stock prices and digs into what you're actually getting for your buck. It's particularly useful for identifying undervalued or overvalued stocks, providing insights that other metrics might miss. But how does it stand up when compared to other valuation metrics? Comparison with other valuation metrics. The P/B ratio isn't the only numerical lens investors use to examine a company. Let's compare it to the price-to-earnings (P/E) ratio and other key metrics to see where its unique strengths lie. P/B versus P/E ratio. The P/E ratio measures a company's current share price relative to its per-share earnings. It gives you a snapshot of what the market is willing to pay today for $1 of future earnings. However, the P/E ratio can be slippery when a company's earnings are erratic. That's where the P/B ratio shines. It provides a more stable benchmark because it focuses on tangible book value rather than volatile earnings. P/B ratio's unique benefits. There are a few standout benefits of the P/B ratio that make it a favorite among investors. Tangible asset valuation. The P/B ratio evaluates the price you're paying for a company's physical and less volatile assets. This is crucial for industries heavy on tangible assets, like manufacturing and real estate. Signal of financial stability. A low P/B ratio might indicate that a stock is undervalued, a potential flag for financially stable investments. Useful in economic downturns. Unlike earnings, which can disappear in tough economic times, a company's assets generally retain value. This makes the P/B ratio handy during financial turbulence. Limitations to keep in mind. While the P/B ratio has its perks, it's not flawless. It doesn't fully account for intangible assets like brand value or intellectual property, considerations that can be pivotal in industries like tech. Plus, sometimes low P/B ratios might reflect deeper issues within the company, such as financial distress, rather than a buying opportunity. When choosing between the P/B ratio or other metrics, consider your investment goals. Are you more interested in long-term asset value or short-term earnings potential? Both metrics have their place, and the best investors know when to use each one for maximum insight. How to calculate the P/B ratio. Understanding how to calculate the price-to-book P/B ratio is like finding a magic key to unlocking a company's true value. This simple yet potent formula lets you peek behind the curtain of market prices and spot potential hidden deals. You don't need to be a math whiz to perform this calculation. By the end of this section, you'll know exactly how to crunch the numbers to use the P/B ratio confidently in your investment journey. Interpretation of the P/B ratio. So, what does the P/B ratio really tell you about a company? Let's break down what different values indicate. P/B ratio less than 1. When a company's P/B ratio is less than 1, it's often a sign that the stock is undervalued. Investors are paying less for the company than the value of its assets. This might signal a buying opportunity, especially if the company is fundamentally strong with sound finances. P/B ratio equals 1. A P/B ratio of 1 suggests the stock is fairly valued. The market price aligns closely with the company's book value. This balance can appeal to investors looking for stability without overpaying for asset value. P/B ratio greater than 1. A ratio above 1 indicates the stock is trading at a premium to the company's book value. This isn't necessarily bad. It could mean the company has valuable intangible assets or growth potential that investors are excited about. But it could also suggest overvaluation, so proceed with caution. High P/B ratios. If you see a particularly high P/B ratio, it's crucial to dig deeper. Is the market overly optimistic, or does the company have significant unaccounted assets, like strong brand equity or future growth prospects? Remember, these numbers don't operate in isolation. Context is key. Always consider industry norms and other financial metrics to get a full picture of a company's health. Are you evaluating a tech giant or a manufacturer? Expectations and assets differ across sectors, coloring how you should interpret the P/B ratio. Factors influencing P/B ratio. When it comes to making sense of the price-to-book P/B ratio, context is king. Various elements can tilt this metric, affecting its interpretation in the investment game. From the industry a company operates into the broader market conditions, these factors provide a backdrop against which the P/B ratio should be considered. Let's explore these aspects further. Industry sector differences. Different industries wear different P/B ratio badges. But why do these figures swing so widely from one sector to another? It's all about the nature of assets. In asset-heavy industries, think manufacturing or utilities, tangible assets form a significant part of the company's value. Here, lower P/B ratios often signal undervaluation because physical assets are front and center. On the other end, asset-light sectors like technology or services may boast sky-high P/B ratios. Why? Because their value often lies in intangibles such as intellectual property, brand strength, or innovation capabilities. These aren't always captured in book value, leading to higher P/B ratios that reflect perceived growth potential or market confidence in future earnings. Here's a breakdown of how P/B ratios might vary by industry. Manufacturing. Generally lower P/B ratios due to tangible asset reliance. Technology. Higher ratios driven by intangibles and growth potential. Financials. Ratios fluctuate, depends heavily on asset management strategies. Retail. Mid-range P/B ratios, reflecting physical and intangible assets mix. Understanding these nuances helps you read between the lines when comparing P/B ratios within and across sectors. Are you aligning your expectations with the nature of the industry? Market conditions. Market conditions are like the weather, ever-changing, often unpredictable, and with a significant impact on financial metrics. The P/B ratio is no exception. Macroeconomic factors, such as interest rates, inflation, or economic growth, play pivotal roles in shaping the landscape where P/B ratios fluctuate. During economic expanses, optimism flows, and P/B ratios might soar as investors pay premiums for anticipated growth. Conversely, in a downturn, the story flips. Uncertainty breeds caution, pushing P/B ratios down as investors shy away from riskier bets. Consider these macroeconomic influences. Interest rates. High rates can depress P/B ratios as borrowing costs rise and economic activity cools. Inflation erodes book value, potentially distorting the P/B ratio. Economic cycles. Boom phases may lift ratios, recessions might lower them. By grasping how these wider market forces interact with a company's financials, you can better assess whether a P/B ratio signals a genuine opportunity or a red flag. Are you ready to weather these market shifts with a well-rounded perspective? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.